For the next hour, you'll be leaving the show me state and entering the show me the money state. So stop what you're doing, grab a pen, and get ready to learn. Jake Floyd of Floyd Financial Group will be your guide for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Thank you so much. Welcome to Show Me the Money, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about retirement in a higher risk world, what retirees need to know right now. Also, 6 fixed index annuity myths busted. We'll also talk about Roth conversions. They sound great, but they're not for everyone. Is your 401k actually ready for retirement, or are you just hoping it is? That's the last thing we'll talk about on today's show. My name's Jeff Shade. As always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from Jake Floyd, Floyd Financial Group. Hey, Jake, how you doing today?
I'm doing great, Jeff. Thanks for asking.
Certainly welcome, my friend. I hope everybody else is having a great weekend. And as always, we really do appreciate you joining us here for Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk. Jake, retirees across the Ozarks are hearing the same thing over and over again right now. Inflation, interest rates, wars overseas, government debt, tariffs, Social Security concerns. A lot of people are asking a very simple question. Is retirement getting harder? So what do you think, Jake? Is it?
I think it's there's two sides to that coin. So I would say that, yes, on one hand, it's getting harder because of inflation and a lot of the things that you mentioned. Spending is higher. But I think on the other side of that coin is you're doing it to yourself. You didn't used to drive a car that was $80,000, and you didn't used to have your $7 coffee every morning. And if we turn back the clock 50 years, 80% of your morning routine you just didn't do. And a lot of those things cost money. If we look forward at retirement, like we talked about, and like we talk about a lot on this show, the last 6 years or so of inflation have been challenging to say the least for a lot of people, especially people on fixed income. But I really think it has to do with our over sophistication of our lifestyle has become crippling to some people, and the bare necessities aren't enough anymore. And so I think that's partially what makes it feel like it's getting harder.
Jake, as you said, 50 years ago, we didn't have $7 coffees. We had coffee for about 50 cents or so. Do you get people in your office who say to you, well, Jake, I may not drive an $80,000 car. I can cut down there, but I really can't cut down as far as gasoline and food goes. There are people who actually have to have those things every single day. Are people just saying no to the extravagances in life today, or are they just taking it for granted and saying, I got to have this?
Yeah, I think by and large, a lot of people that are retiring right now that started working in the 80s, they've been the beneficiary of the market through that period. So if you did a good job saving early on, you have made lots of money on your money, which is enabling you to retire in a way that you might not be able to had you started working 10 years sooner or later. I do think that having a plan is more important today than it's ever been, because you really need to be ready for whatever this next 10 years may throw at us, which is hard to put a finger on. And I think that looking forward, as AI does its thing and really starts to change things around here, we need to make sure that we have a plan and we stick to that plan, because things could get rough at some point. Now, I personally think that from an investment standpoint, that things are going to be very good over the next 5, 6, 7, 8 years. But not everything's about money, and there could be other challenges, especially younger families, as certain jobs kind of go away because of AI. That's going to hurt most to young families that have been, bought houses that maybe they're on the borderline of being able to afford with 2 jobs, and if they lose one of those jobs, they're in trouble. I think those are the people that are going to pay the price, but I do think that retirees and people who are invested are going to be okay as long as we have a good plan.
And I would agree with you completely, Jake. Having a plan is so important. But what I meant by that question is I have begun to make some choices in the supermarket, and with a lot of things that I do, instead of buying the name brand thing, I'm buying lesser things, and some things I just don't buy anymore. When it comes to those little sandwiches and things you get in the supermarket, I wait until they're marked down half price. I look for those things, but I've made a choice. There are just some things that I will not buy. If more people did that, I don't know. I don't see prices really coming down. If people said I refuse to pay $6-7 for a little turkey wrap in the supermarket. Do you think that the powers that be would get the message and reduce those prices? Or are we just stuck with inflation like this for the near future and the distant future and just count on it as part of the plan?
I think they absolutely would reduce prices if people did that. Walmart has record profits and record profit margins right now. So that tells you that while prices are going up, it's not necessarily the cost of everything that's going up, right? It's being capitalized on by large companies, especially monopolistic type companies like Walmart and others. They know that you don't have much alternative. They know that you're not going to stop spending, and so they just keep raising the price. If they stopped selling things, they would absolutely lower the price and figure out how to make that work. But I honestly don't see that happening. And I think there's a lot of people complaining about inflation, and I do think things are more difficult in some ways, but people are also making more money than they've ever made. The market's been good. Wages are up more than inflation over the last 6 years. Wages are up a lot. I do think that people will always find something to blame for their lack of planning, but I do think that there are some things that are more difficult. You didn't have to watch it quite so hard when you go to the grocery store. But again, one of the big changes too is people eat out 5, 6, 7, 8 times a week. Some people eat out more than that.
Wow.
And that didn't used to be the case 40 years ago. Eating out was kind of a big deal, and it was special. It wasn't like, hey, it's lunchtime, I'm going to go eat out again. So I think some of it is lifestyle choices to blame, not just the inflation. But I do think that the cost of everything's definitely up.
Well, I certainly am seeing that too, and I needed a pair of athletic shoes, and I made the choice. I could go to Dillard's and get those, or I could go see what they've got at Walmart, and I chose the latter. Talking with Jake Floyd, Floyd Financial Group, our phone number 417-889-7233. If you're feeling the pinch of inflation and it's not built into your plan, you would like a retirement plan that accounts for all the things we're going to talk about today. No cost, no obligation, 417-889-7233, and you can make that call right now if you want. Jake, Wall Street spent the last year expecting a lot of Fed rate cuts, but now many analysts think that rates could stay higher much longer. Why does that matter to retirees here in the Ozarks?
So interest rates are a direct input to the cost of housing, cost of living, how good business does when they need to borrow money, how much it costs them. Having interest rates lower is generally better for the economy. It's better for housing prices. It's better for the stock market. And I think that for a while there, we were pricing in quite a few more rate cuts than what we had been previously. But over the last, let's say, 10 weeks or so, the market has begun unpricing those in, meaning there's something out there called Fed funds futures that people trade to kind of try to profit off of what the Fed might or might not do. And as of right now today, there's no rate cuts and there are no rate raises priced in all the way through the end of 27. People are expecting it to stay exactly where it is now, which is fascinating. I'm not sure I've ever seen that curve flat like that before. I don't remember ever seeing it flat. Generally, we're on the rise or on the decline, but I think that interest rates want to come down, but as long as we have the fuel prices, the Iran situation, and oil prices high, it's going to be hard for interest rates to come down.
Jake, regularly in this segment, we talk about reports, and I wanted to get your input on the employment report today. What is happening in today's world as far as employment goes?
Yeah, so last week, the employment jobs numbers came in, and we were expecting a low gain, and it ended up being like double what they were expecting. So we're seeing a lot of layoffs, but we're also seeing a lot of new job creation so far. So we haven't seen a lot of unemployment, underemployment, or at least not new underemployment. So underemployment's where somebody's working at a job that's, if they have a master's degree and they're working at McDonald's, that would be underemployment. And the unemployment rate has not risen just a teeny bit, but not very much yet. So I think overall, the AI has not put as many people out of work as people were expecting. Now we're seeing a lot of people in coding and computers and things like that getting laid off, but it's creating jobs other places. So far, that's the way that's been going. Now, we also have to wonder whether or not these numbers that they're feeding us are actually true. During the whole entirety of the Biden administration, we basically found out that those numbers were cooked. They were just manufacturing these numbers, and what happened is they would put out those numbers this month and they say, okay, we created 100,000 jobs this month. Yay, let's do that. Then what happens is each month subsequent for the next 2 months, they revise that number. So you get this month's numbers, you revise the previous month and the month before that each time they report. And so they'd say, hey, we have 100,000 jobs created, but then the next month they'd say, hey, we have 100,000 again, but last month we're going to revise that to only 50. And then the following month they'd revise it to basically none. And so they were just constantly making it try to sound good, but there really wasn't much job creation going on for a lot of the Biden administration. So also with Trump, whether or not these numbers are perfectly accurate, I don't know. One of the first things he did when he got in there was fire the person responsible for those numbers. So now there's somebody that Trump likes doing those numbers. So I'll let you decide whether or not those numbers are perfectly accurate. But I would just say that so far we have not seen a huge amount of unemployment from AI, because a lot of the jobs that are going away are getting replaced with others.
Well, Jake, here we are in the month of May, and I've always heard this saying, sell in May and go away. It's a traditional investment adage suggesting that investors sell stocks in May and then re-enter in November. Would that be the case this year, do you think?
Jeff, I don't think so. I think we're going to see this thing continue to tick higher. Now, again, we have gone pretty far up pretty fast over the last, let's call it 50 days or so. So I do think we could see some retracement of that, meaning it could come back down some. But I do think that a year from now, we're going to be higher. Whether or not 6 months from now, we're going to be higher, I personally think we will be. But the good news is we don't have to necessarily guess at that, right? If we have a plan and we have an investment strategy, we just execute that. We don't have to necessarily be right over the next 4 months, 6 months, whatever it is. I would say if you have a lot of money that hasn't been exposed to the market, I don't know that this is the exact moment to jump in. But I also would say that I could see it ticking higher through the summer as people go on vacation and people just keep funding their 401ks, trading volumes go down, and probably the market just goes up 0.1% here, 0.3% there, and before you know it, we might be 4 or 5% higher through the summer. So that's kind of my base case, but I reserve the right to change that as the news and geopolitical environment changes too.
Well, Jake, we bounced around a little bit in terms of topics here. We talked about inflation, we talked about rate cuts, and we talked about a lot of things here. Employment report. If you had to summarize the biggest retirement challenge right now to people listening to this program in one sentence or two sentences, what would it be?
Yeah, Jeff, I think that, inflation, taxes, interest rates, volatility, all those things are connected, and all those things are potential threats to your retirement. And so having a plan that gets executed as you get 5 years from retirement, 2 years from retirement, you retire, and then 5 years into retirement, that plan needs to check some boxes for you. And if you don't have a plan, we don't want to just buy and hold and throw it all in the stock market and hope for the best. We need to have an income plan. We need to have some diversification of strategy. And if we do those things, then even when we hit the potholes, we can recover. What we don't want to do is get wiped out if the market has a big down at some point. So if you don't know for sure that you have that plan in place, give us a call. That's what we do here, and we can help you get it shored up.
Jake, great conversation here. I want to talk to our listeners for just a moment. You've worked hard to build your retirement. The question now is, do you have a plan to protect it? Rising inflation, taxes, and market uncertainty can quietly erode everything that you have spent decades building. Well, as Jake said, you can call us here at Floyd Financial Group and request your complimentary Floyd Financial Group review and get a clearer picture of where you stand. Our phone number, 417-889-7233. It's 417-889-7233. Absolutely no cost, no obligation, no judgment. We'll meet you where you are. This could be the most important phone call that you'll make all year. 417-889-7233. You can also visit us on the website at floydfinancialgroup.com. Jake, time for a break. When we come back here on Show Me the Money, we're going to be talking about 6 fixed indexed annuity myths busted when Show Me the Money continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this segment, we're going to be talking about 6 fixed index annuity myths.
Jake, there's a lot of confusion out there about annuities, especially fixed index annuities. Some people think that they're the greatest thing ever, and others think that they're financial quicksand. Well, today we're going to separate fact from fiction because for retirees right here in the Ozarks, Jake, guaranteed income and protecting retirement savings has really become a huge concern, hasn't it?
Absolutely, Jeff. And I think that when we get to retirement, thinking about what types of financial products that we want to use, there's a lot of disinformation out there. People make decisions based on what YouTube says or what some influencer says or what some actor on TV says. And so I would just say be careful with that because all those people are making money off of you and they have an axe to grind. So I'd be a little careful who you take advice from. And that's honestly why I do what I do, is making sure that people have a trustworthy source to answer questions, give all the pros, but also all the cons to the situation.
Jake, there's definitely a lot of misinformation out there, as you said, and honestly, some people are making retirement decisions based on myths instead of facts, and they're getting those myths from YouTube and TikTok and all the social media platforms. Fixed index annuities, or FIAs, as some people call them, they're not perfect for everyone, but when they're used correctly, they can solve some very real retirement problems. So let's start with probably the biggest criticism that I hear. People hear annuity, Jake, and they immediately think hidden charges and giant fees. Is that always the case, and is it the case with fixed index annuities?
That is not always the case. There are some fixed index annuities that have really, really high fees, to be sure. It's important that we keep an eye on those things, but there are some that I like to use that have no fees at all. If you have money in a strategy that has no fees, and you have some money in other strategies that do have fees, or let's say you have some money in the market, somebody's managing for you, having a fixed index annuity can help you lower those fees, actually. A lot of it has to do with whether we're paying for a lot of riders and things like that, whether it's income riders or death benefit riders, and trying to sort through all that can be very overwhelming to the average person because there's something like 100 carriers out there or insurance companies that offer these, and probably a couple thousand plus products. And it's very hard for the layman, the person who is not inundated and buried in all this information all the time. It seems like gibberish. And having an advisor who has a relationship with these companies and also has some experience with these companies to understand how they're going to treat their clients over the years, to understand how things are going to go, because a lot of fixed index products are going to have time commitments to them. So if you're going to have a time commitment on your investment, we want to make sure that they're going to hold up their end of the bargain and you're not going to be wishing you had not done what you've done.
Jake, for those people who listen to this show regularly, they know that we talk about annuities in terms of the different types of annuities. There are immediate annuities, there are deferred annuities, there are simply annuities, fixed index annuities, and then there are variable annuities. So there are different types. And with a fixed index annuity, you'll get a portion of the upside of the index, and there's a floor of 0. I mean, it all sounds great. So why do some people listen to what's going on in the media, and some people say, well, I hate annuities? Well, why do you hate annuities? Because the guy on the radio said I should hate annuities. Why would we want to hate anything like this that appears to have so many positive attributes to it?
I think the biggest reason is that they're misunderstood. Some of that's the advisors not explaining things. But I think a lot of it is there's an incongruency with what people think they're getting and what they're actually getting. And regardless of who's to blame for that, if these products are properly explained, there's a lot of good things that they can do, but they are not appropriate for everybody. There are some people that are just like, what you really need is an annuity, whether you're 10 years old or you're 100 years old, annuity, annuity, annuity. And that's just really not the case. There are reasons to use annuities. There are reasons to not use annuities. And having an advisor that is unbiased when it comes to that is important, because you don't want to get stuck with something that doesn't fit your goals and needs.
And I agree with you completely, Jake. Saying all annuities are bad is like saying all trucks are bad, or all mutual funds are bad, or all medicines are bad. You have to evaluate the purpose. Some people need growth. Some people need protection. Some need guaranteed income. Retirement planning is about matching the tool to the problem. Now, one knock against annuities that I hear sometimes is annuities can't keep up with inflation. How does that apply to fixed index annuities?
So I think there is some truth to that statement, Jeff, that some annuities will have trouble keeping up with inflation, but there are some annuities that will not have trouble keeping up with inflation. One of the biggest factors when considering an annuity is how does it make money? Are we talking about a variable annuity that tracks the market? Are we talking about a fixed annuity that tracks rates like similar to CD rates? Or are we talking about a fixed indexed annuity that can protect your money but also give market-linked gains? If we're talking about a fixed indexed annuity, what is the strategy that we're using? Are we using like a cap strategy or a participation strategy? And again, this is where things start to get kind of confusing, but there are annuities out there that can make a pretty good buck. And while regulation prohibits me from talking a lot about percentages on the air here, I would just say that we're talking better than CD rates can be had, and in some cases, quite a lot better. When we're looking at these annuities, though, there's no one annuity that's good at everything. So if you have an annuity that's really good at lifetime income, for example, that annuity is likely not going to make nearly as much money as an annuity that's focused on growing your money. There are annuities that are liquid, but annuities that are more liquid tend to sacrifice either safety or growth to get that. So again, really understanding what you have is important, but when it comes to inflation, I do think there's a lot of fixed index products out there that can more than hold their own against inflation.
And Jake, I think it's important for people to know here that an annuity is not an entire retirement plan. It's just one tool that you use in a plan, right? Can you explain that?
Yeah, so nobody's money all belongs in an annuity. I can say that definitively. You don't get too many definitive statements out of me on the radio because you get a lot of it depends.
Right.
But I can tell you that 100% of your money does not belong in an annuity, period. Full stop, no notes. And the reason for that is while we like the safety and growth of some of these fixed index products, it does tie your money up for a certain period of time. There are a few annuities out there that have return of premium riders where you can get your money back, but generally speaking, if they're not liquid, it just means you can get your principal back. So if you're 3 years in, you can go back and take your money out, but you don't get the growth that you got over that 3 years. So it's important to have more than one investment in your investment strategy. In fact, I would even go one step further and say it's important to have more than one strategy in there. So like if I'm managing somebody's money in the market, I like how fixed index annuities complement my strategy because there may be years where I knock it out of the park, right? And the annuity doesn't have as good a year. But there may be years where I'm not perfect and there may be a year or two where things don't go as well. And the annuity does not mirror my strategy. So the chances of the annuity carrying in that, either because the market's down, it's not losing, or just because the strategy is different than mine, I'm not conceited enough to say that my strategy is the best, period, the end. It depends on the environment, and it depends on the year, and I'm going to do my very best to manage money, but there's going to be years where it doesn't go as well as other years. And so having diversification, not only of investment, but diversification of how those investments make money, I think is important too.
Talking about annuities here with Jake Floyd and some myths around fixed index annuities. 417-889-7233 is our phone number if you'd like to continue the conversation with Jake. 417-889-7233. You can make that call right now for your Floyd Financial Group Retirement Review to talk about annuities. Jake, you touched on this a little bit. Another criticism, once your money goes into an annuity, it's trapped forever. Is that another exaggeration, or how exactly does it work?
It's definitely not trapped forever. There's a lot of different lengths of fixed indexed annuity contracts. So there's a few out there that are like 3 years. There's some out there that are 5 years, 7 years, 10 years. There's some that are 16 years. And what's appropriate there really depends on your goals. In the environment that we're in right now, though, I will say that some of the longer term ones tend to be, in my opinion, a little more attractive. And the reason for that is if interest rates are relatively high right now, you want to think about interest rates as the horsepower inside of a fixed indexed annuity. What interest rates are when you buy the annuity affect the entire term of the pricing of that annuity. So if we do a 5-year versus a 10-year, and 5 years from now, if interest rates are zero or much lower than they are now, we'll be wishing we'd done the 10-year because at the end of 5-year, your ability to make money will go down substantially. However, if you had done the 10-year, then you have 10 years of hedge against that when interest rates are high. So I'm generally in favor of doing a little bit longer ones right now. Now, if interest rates were really low right now, I would say, hey, let's do a shorter one because the chances of the earnings power inside the annuity being better 3 or 5 years from now is pretty good. Then we want to do a shorter one. So they are definitely not too illiquid. Most fixed index annuities allow for 10% free withdrawal each year. That means you can have 10% of whatever the balance is each year. So that allows for taking income. So, if you're taking 10% income per year, you're not going to have money very long. So generally 4 or 5% is what we would take out. So that's within the 10% that you can have. I would say the vast majority of annuity owners, if the annuity is not the only thing they own, really don't ever recognize how long the annuity is because it's not really a factor because they're just taking their income and it's keeping their money safe and growing. So as long as we don't put too much money in the annuity, then most of the time it's really not an issue. But there are people that really need to not tie their money up at all. And that's okay too. And like I said at the beginning of this, annuity is not right for every single person. But I do think it's a useful tool as we get close to and in retirement.
Jake, with a fixed index annuity, of course, it follows an index and you can pick the index. Let's say it's the S&P 500. I think one thing that people misunderstand is that a fixed index annuity is not actually an investment in the stock market, is it?
Right. Your money is never invested in the stock market. Your earnings are linked to the stock market, but your money is never invested directly into stocks. And it's because of that, that's how you don't have any risk. But when stocks go up, you have gains that are linked to the stock market. So like you said, this is technically an insurance product, not an air quotes investment.
Mm-hmm.
However, it does make money. And if we're comparing fixed index annuities to other safe investments like bonds or real estate or gold or whatever you perceive to be a safe investment, you're going to earn a lot more on it than you are in cash. You're going to most likely earn more than whatever a CD is paying, assuming we select the right product. But you also have absolute principal protection where you're not going to lose any money. Nobody has ever lost a single penny in a fixed indexed annuity since the advent of them in 1995, ever. Even though there's been insurance companies go under and all that kind of thing, they still made good on all their promises. Other companies have bought them up and that kind of thing. Nobody's ever lost a single penny ever. There's not very many things you can say that about. So as far as safety is concerned, a fixed indexed annuity is one of the safest places on earth you can put your money. When we compare it to other safe investments, as long as we're choosing the right fixed indexed annuities, for the most part, they are going to earn more money than, let's say, bonds. Bonds have averaged about 2.5% over the last 10 or 12 years. A lot of the fixed index annuities that we like to use are obviously way higher than that. So we get actual principal protection where we can't lose, and we still get a pretty good return on the money at the same time.
We're talking about the myths surrounding fixed index annuities with Jake Floyd Financial Group, and there's obviously no magic product in retirement planning, but there is danger in making decisions based on misinformation or fear. A lot of people have spent 30, 40 years building their retirement savings, but they've never stress tested what happens if the market drops hard again. Inflation stays high, taxes go up in retirement. Well, that's where people can get blindsided. One bad sequence of decisions in the first few years of retirement can permanently damage your lifestyle. Here at Floyd Financial Group, we help retirees and pre-retirees build a written retirement income strategy designed to help protect what you've worked a lifetime to build. So if you have serious questions about your investments, taxes, income, market risk, or fixed index annuities, call us for your complimentary Floyd Financial Group review at 417-889-7233. It's 417-889-7233. Don't wait for the next market shock to discover your plan has holes in it. Call us right now at 417-889-7233. No cost, no obligation, no judgment. We would love to sit down with you. Jake, time for a break here on Show Me the Money. When we come back, we're going to be talking about Roth conversions. Well, they sound great, but are they for everyone? When our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready to climb a mountain of financial know-how? Good, because it's time for more Show Me the Money with your financial Sherpa, Jake Floyd.
Welcome back to Show Me the Money. I'm Jake Floyd. In this segment, we're going to be talking about Roth conversions. Sound great, but they're not for everybody.
And Jake, if someone watches financial TV for about 5 minutes or scrolls around the media, they'll hear the phrase Roth conversion over and over again. It's becoming one of the biggest retirement buzzwords out there. But today, we're talking about the reality, not just the hype. Can you give us a little insight on that statement, Jake?
Yeah, so the reality when it comes to Roth conversion, like we said, is it's not for everybody. And there's a lot of considerations we need to take into account when we're considering a Roth. Generally speaking, people who are lower income and lower assets benefit from Roth a little bit more than Roth conversion, I should say, than other people. And the reason for that is if you are paying taxes to convert to a Roth at a high tax bracket now, and you're likely to be in a lower tax bracket in retirement, that generally doesn't make sense. So I would say personally that probably 90% of people it doesn't make sense for. But we'll kind of unpack that as we go through here.
So Jake, for those people who do not know what a Roth conversion is, can you lay it out to us in simple terms?
Yeah, Roth conversion is where we take pre-tax dollars, so 401k, IRA, 403b, 457, and we convert it into a Roth IRA. And so a Roth is where we pay the taxes now, but once we get past 5 years, all the growth is then tax-free forever. And so the reason people would want to do that is if they think that tax rates, either for them or in general, will be higher later than if we pay the taxes now, then we get it tax-free later. That's the assumption. Now, the reason why I'm not as optimistic on Roth as some people is probably 95% or more of people will actually pay less in taxes in retirement than they do before they're retired. And a lot of that's just because their gross income won't be as much. They won't have Social Security tax and all that kind of thing in there. And generally, the gross income is going to be less, so they'll pay less in federal income tax and that kind of thing. So when we're looking at whether or not to do a Roth conversion, I think that's an important factor to consider is, are we actually going to pay more as a percentage later or less? If we're going to pay less, then it doesn't make sense to pay 27% in taxes now to save 12% later. So that's why I'm generally skeptical of most of the Roth conversions that get done. However, if you are in the 12% bracket right now and you have some room before you get to the 22% bracket, it can make sense to systematically take some of your money and convert it each year so that just in case tax rates go up later, you're protected from that.
Jake, we're talking about why Roth conversions may not be right for everyone. What is the biggest misconception that you hear about Roth conversions?
Yeah, Jeff, I think that probably the biggest misconception is that everybody needs to do a Roth conversion. And like we said, we don't really agree with that. Another misconception is we should convert everything all at once. And I would say that very rarely makes sense to convert all your Roth all at one time. For the most part, for people, it's going to make sense to do it over a series of years to control what tax bracket that you're in as you go through it. Because anytime you convert to Roth, that money is just considered ordinary income. So if I take $50,000 and convert it to a Roth, that stacks on top of my other income. So if I make $100,000 otherwise, now I'm making $150,000. I've just gone from the 12% bracket to the 22% bracket, which is generally going to cost you quite a bit more in taxes on that. Versus if we keep it under that tax bracket threshold, that's a good thing. So if we, by doing it over 5 years or 10 years, then you can do a little bit at a time and make it so that you're not affecting your current tax bracket by doing it.
So, Jake, it sounds like this is becoming more of a chess match rather than checkers. It's really not a quick decision, is it?
No, it's not. And I think that it's important to take into consideration quite a lot of things. If you are doing it before the age of 65, you need to consider what it might do to your health insurance premium if you're on Obamacare. If you're doing it after 65, you need to consider IRMA and what might happen if you do too much. It might affect your Medicare Part B premium. There's a lot of factors to consider out there, and I'm happy to go through that with anybody who wants to. But I will say that generally speaking, a lot of people are talking about Roth conversion are people trying to sell you something. So it's a hook. It's like, hey, doesn't it sound good to have all your money tax-free? Well, come see me and I'll show you how to do it.
Right.
And then what happens is people go in and see them and they're like, oh, it's not right for you, but by the way, I have this thing you should buy. So just beware of that whenever you hear people that are really excited about Roth conversions. There are some situations where it makes sense, but just realize that that can be a situation where people are trying to take advantage and get you to buy something that may or may not even be related to the Roth conversion.
Talking with Jake Floyd, Floyd Financial Group. We're talking about Roth conversions and whether or not they're right for everyone. Our phone number, 417-889-7233. It's 417-889-7233 for your no-cost, no-obligation Floyd Financial Group review, which will include a discussion about Roth conversions if you wish. So, Jake, who are good candidates for a Roth conversion?
Yeah, so I think people that are in a relatively low income bracket and have some room before the next bracket can be a good candidate. I would say the best candidate of a Roth conversion is someone who has a lower income but has beneficiaries that have high income. So meaning if you make $60,000 a year, but your kids make $250,000 a year, you can pay those taxes for them, so when they inherit the money, then they don't have to pay 40% in taxes. Generally speaking, though, that requires you making a decision ahead of time on whether you want to spend all your money, and whether you want to set aside money for them to 20 years before you may pass away, right? Because we're probably not going to Roth convert on your deathbed. We're going to do it earlier in life. And so a lot of people don't want to give up the control of that money or want to make a decision that's going to affect them negatively just so that their kids can benefit. Most people say, hey, if there's money left over, I want my kids to get it, but I don't necessarily want to skimp on everything so that they can inherit more money. But the best people to do Roth conversion are lower income earners with kids that are high income earners to pay the taxes for them.
So, Jake, there's a reason why someone should do a Roth conversion. Why shouldn't someone do a Roth conversion?
No, that's a good question. I think that there's a lot of cases where people are trying to convert to a Roth in the 22% tax bracket when they're going to take a significant hit to their income in retirement anyway, and probably only pay 12% in retirement. So you're actually spending tax money that you don't have to spend to get protection that you don't really need. Now, there's a lot of people, especially in conservative America, that believe that taxes will go up in a big way at some point, that Congress is going to vote in income tax increases on the vast majority of people. I am not really in that camp. I don't believe that that's going to happen simply because these people want to get reelected. And if they want to get reelected, one sure way to not get reelected is to start raising taxes on everybody, because nobody wants higher taxes. So generally, they're pretty careful about how they raise taxes to affect the 1%, simply because they don't want to be in a situation where their policy negatively impacts 98% of their constituents, because guess who's never getting elected again? That guy, right?
Right.
So Chris Christie, for example, has proposed cutting Social Security by 20%. Guess who has the lowest approval rating of anybody I've ever heard of? Chris Christie. He had like 7% among a group of his constituents.
That's crazy, yeah.
I'm not sure that you can get that low on anything. I mean, I'm sure Hitler would have obliterated that.
Probably so, yeah.
Even at the height of the war. And so we want to make sure that we don't create problems that aren't real in fear in retirement. And so I personally do not believe that the bottom 98% are going to have big, meaningful tax increases. There may be a little bit of ebb and flow, but I don't think we're going to just see like a 10% tax increase on people making $100,000 and less. So because of that, I'm hesitant to throw money out to taxes and the earnings on that money thrown out to taxes, because we're concerned about something that is not very likely to happen in the future. So I would rather keep the situation simple and work with what we have, not pay too much in taxes. If we have some extra room, we could do a little bit of Roth conversion. You don't ever have to fully convert to a Roth either. You can say, hey, I got $500,000. This year I'm going to convert $30,000 because that's how much I can do without moving to the next tax bracket. And then the next year it might be different. Say, hey, I made a little bit less this year at work, so now I'm going to convert $50,000. And then the next year you might have a better year and say, hey, I'm not going to do any this year. And only do it when it makes sense. That's also a good strategy.
Jake, what about younger people listening right now to the program, or those people who are advising younger people? What do you want to tell them about Roth conversions?
So I would say that Roth conversion, and if you have somebody that's young, they're probably not going to be converting to a Roth because they probably don't have an IRA to convert. But whether they fund IRA or Roth at the beginning in their 401k, again, really comes down to tax brackets. In my opinion, and again, this is not blanket advice, but if you want guidelines, if you are in the 12% tax bracket on the Fed or under, then funding a Roth or doing a Roth conversion can make sense. If you are at 22% to the Fed and 5% to the state, in my opinion, most of the time it does not make sense to do a Roth. That's my kind of guidelines. Now, again, there are exceptions to that, but as a rule of thumb, that's how I look at it.
Jake, today's big takeaway from this conversation, I think, is this: Roth conversions can be incredibly valuable, but only if they're done strategically.
Exactly. And I think that we shouldn't be doing retirement planning based on TikTok videos or YouTube videos or what the news media has to say about it, or really even what somebody like me on the radio has to say about it, right? You need to really evaluate it, and we need to have a plan with what we're doing. And that's why we always say that. We say, hey, you need to have a plan. Part of that plan is whether or not we should convert to a Roth. So part of that's income plan, investment plan, but part of it is whether we should convert. Having that plan and executing that plan is the most important thing.
You know, Jake, I think a lot of what scares people today is that they spent decades building retirement savings, but they may have no idea what kind of tax bomb is sitting inside those IRAs and 401ks. And once you retire, bad decisions become very expensive quickly. Higher taxes, bigger Medicare premiums, IRMA, more taxes on Social Security, even running out of money faster than expected because nobody built a coordinated withdrawal strategy. That's why this matters. If you would like to discuss Roth conversions more in depth with Jake, call us here at Floyd Financial Group, 417-889-7233. Absolutely no cost and no obligation to this consultation. Again, it's 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Jake, it is time for a break. We come back here on Show Me the Money. We're going to be talking about whether your 401k actually is ready for retirement, or are you just hoping it is, when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to be talking about, is your 401k actually ready for retirement, or are you just hoping it is?
And Jake, millions of Americans check their 401k balances almost like they're checking a scoreboard. Did it go up today? Did it go down today? But the real question isn't how much is in there. It's whether that money can actually support your retirement someday.
That's true, Jeff. And I think that there's a lot of people that get to retirement thinking that the same investments they've always had are the ones that they need through retirement. And I think your 401k needs to have a checkup. You need to look at it and say, okay, what was appropriate for the last 40 years may or may not be appropriate for the next 20 or 30 years of retirement. And we need to be careful, because the biggest risk you have in retirement is taking a large drawdown once you start taking money out, because you don't have time on your side to let you get back to even. And you don't want to have to sacrifice your lifestyle, meaning, hey, the market's down, I'm not going to take any income, right? We want the income to come regardless of what's going on in the market, so that you can live your life. But if you have too much risk in your portfolio, sometimes that can be a challenge. Let's say that you're taking a 5% withdrawal off of your money, and then the market takes a 50% tank like it did in 2008. Now, all of a sudden, you're withdrawing 10% of your portfolio, and 10% is way too much, and you will probably never get back to even, no matter what the market does in that scenario. So eliminating large drawdowns and just making sure that your 401k is set up properly for retirement is important.
So, Jake, I think what we're really talking about here is giving your retirement account sort of a checkup or a tune-up. Would you say that?
Yeah, I think looking at things, I would say it's maybe more an inspection than a tune-up, or at least that's where we should start, right? Let's look at it. Let's make sure it's roadworthy. Let's make sure that the blinkers are working, the taillights are working, and the glass is intact on your windshield after the hail we had over the last couple of weeks.
Yeah.
Just making sure that it's good to go. Some people are going to be good to go, and people are sometimes stunned. It doesn't happen super often, but probably 5 or 10% of the time people come see me and I say, I think it's good as it is and you don't need my help. And I will tell you that if you come in here, and I believe that to be true. However, if I think there's some tweaks that we can make, some things we can change to make it better, I will say that as well. And so having that inspection or that checkup, tune-up, for your 401k or your IRA if it's no longer inside your 401k, just your overall retirement accounts, I think is something that you want to do on a periodic basis. When you get 5 years from retirement, you should really be looking at this. 2 years out, you should be looking at it again. At retirement, you should be looking at it again. 5 years into retirement, you should be looking at it again. And maybe even more often than that, but at least you want to be looking at it there and going, okay, is this still appropriate for where I'm at in my life cycle?
And Jake, a lot of people have 401ks in the beginning with a retirement number in mind. This is how much it's going to take for me to live a good life in retirement and not run out of money. So I want to talk about this retirement number. Is there actually a retirement number that people should be shooting for with their 401k as the tool?
No, I mean, everybody's number is so different. And a lot of it comes down to your income needs in retirement and then your overall risk tolerance. If you have a higher risk tolerance, you may not need quite as much money as somebody who has a lower risk tolerance. But if you're used to living on $150,000 a year while you're working, you're probably not ready to live on $50,000 a year in retirement. But some people never made more than $60,000 or $70,000 a year when they were working. And so $50,000 in retirement might be totally fine for them. And so it's going to be very much a case-by-case basis. What's important to you, what you want to do in retirement is another big factor. And the adage that I use a lot is maybe you like fishing in retirement. Do you need a $100,000 bass boat and a $80,000 truck to pull it around to go fishing? Or are you comfortable just fishing off the bank? And those two things come with very different price tags. Or if you say, hey, I like to travel. Well, do you want to travel to Tulsa, Oklahoma, or even, let's say, Tucson, Arizona? Or do you want to travel to Rome and eat at 5-star restaurants? So those are different things from a cost standpoint, therefore require different income amounts, and therefore require different amounts of savings to make it happen.
And you sort of sparked a memory there, Jake. When you're talking about fishing, I remember as a kid, my grandfather was retired and we used to go fishing as kids. We drove in a 49 Chevrolet and he would pick me up at the house and we would go off to some creek there in southern Ohio. We had bamboo fishing poles. We made our own hooks and we brought bologna sandwiches and we were as happy as we could be. That was what his idea of retirement is, but I don't think that sort of retirement vision really exists for a lot of people anymore. You always hear advisors say, get the company matched. Why is that so important?
Yeah, getting the company match is just free money. Under most safe harbor plans, if you contribute 5%, they'll match 4%. There's some variation in there, but a lot of big companies are going to do the safe harbor. So if you put in 5%, and let's say you make $100,000 a year, that's $5,000. They're going to put $4,000 in for nothing. So that's an 80% first year return on your investment. That's pretty good. And that really stacks up over the years. If you start doing that when you first start working and then you keep doing it through your retirement, you're going to have a whole bunch more money than you would have if you had not done it. So getting the match is a big deal. And I think the very first retirement savings you do should be that. Sometimes people are like, hey, should I fund an IRA? Should I buy gold? Should I do this? Should I do that? The very first thing you should do if you're starting out is get to that match. If you're not funding enough to get the match, the whole match, then keep working on that until you do, and then worry about doing something else. No matter how good your investment guy is, he's probably not going to make you 80% the first year.
No. Certainly that is something that we would hope for, but we couldn't count on. Jake, for those people over 50 years of age, they've looked at the 401ks and they say, wow, this is not where I thought it should be. Are there things like catch-up contributions, and how do they work?
Yeah, so catch-up contributions start kicking in at 50 years old, where it'll let you fund a little bit more into your 401k. Now, I will tell you that a 401k already allows for $23,000 a year, roughly, to be funded into it. So most people are not funding that. There are some out there that are bumping their heads on that. When you get to 50, you get an extra $8,000 added to that. From 61 to 63, there's an extra little bit more bump, the super catch-up, or however we want to call it. But most people are going to struggle to fund $23,000 a year into a retirement plan. If you are funding that much, we should probably talk about it and say, okay, is this the appropriate place to be funding this? What age are we? How far are we from retirement? And let's kind of check in on that, because we may not want to put all that money into a retirement plan, or we might. It depends on your income thresholds and whether you have an appropriate amount outside a rainy day fund, that kind of thing. But there's some considerations to talk about there. But if you are max funding your 401k, good for you. You're going to be glad you did, probably.
So, Jake, within the 401k, of course, we have investments, and a lot of people just throw their money into target date funds and they never think about it again. Is that a good idea?
I wouldn't go so far as to say it's a bad idea, but I would say that I am not a big fan of target date funds. There's a couple of reasons for that. Target date funds are basically a mutual fund that holds a bunch of other mutual funds from that same company. Not every time, but many times you get charged on the target date fund for investments. You get a fee for that. And then inside, all those other mutual funds also have a fee. So you're getting double dipped on fees. That's my biggest problem with them. There are a handful of carriers out there that don't charge on the wrapper and only charge on the underneath, but there's a lot of them that are double dipping. My second problem with it is they are typically very biased to international investments. So your average target date fund is somewhere around 40% international investments, which to me is way too much. I don't have any big issue with international investments other than the fact that over a 10-year period or longer, you're going to see those returns get totally dwarfed by the United States stock market. Over the last 10 years, I think the S&P is up about 14.5% per year. And the average international investment is up about 7%. So you're just costing yourself money. I have a few other big problems with it, which is that I really don't want my money overseas anyway. If you have 40% of your money overseas, that means 16% of it roughly is in China. Life's hard enough without having to worry about whether China is going to nationalize a company you're invested in. So I have a very heavy America bias. I think in my model right now, I have one international stock, and that's Taiwan Semiconductor Manufacturing Company. And we can talk about why that one's in there if you want. But I'm not opposed to investing internationally. It's more just I need a good reason to do so.
Jake, let's talk about risk in those investments in retirement. A lot of retirees get hammered during market downturns because they didn't realize how aggressive that they were in their 401k investments.
Right. And when you're starting off, you have $30,000 in your account and you lose 30%. Now your investment goes down to $21,000. You're like, I don't like that, but I'm just going to keep funding it. Then before you know it, you're back to all-time highs, and now you're at $100,000. When you get close to retirement, and you have $1 million in there, and you lose 30%. Now you're down to $700,000. You just lost $300,000. So as you get closer to retirement, it matters more because at some point you're going to have to start taking money out. And evaluating your risk profile, making sure that it's still appropriate for you, like I said earlier in this segment. That's a big deal. And I think that's one of the big things that I talk about when people come in to see me is, hey, we've done well. I'm sure that you've done really well over the last 4 years in this high growth type of setup. But it might be time to tap the brakes a little bit here, and let's look at a way to make sure that we're not going to take a 30, 40, 50% drawdown in the future, because eventually the market will give us another situation like that. So we need to have a plan that accounts for that, as well as accounts for if the market keeps doing well.
Talking with Jake Floyd at Floyd Financial Group, and we're talking about your 401k and how you should give it a little checkup now and again to determine its health and whether or not you need to change course. Jake, I think one of the biggest retirement myths in America is this idea that if you simply have a 401k, you're automatically okay. That's not a retirement plan. It's just an account balance on a screen. Now, I think the real question is, will that money generate enough income? Can it survive inflation, higher taxes, a major market correction right before or during retirement? Because one bad decade or one badly timed downturn can permanently change someone's lifestyle in retirement. So if you've worked hard, you've saved seriously, now's the time to find out whether or not your retirement strategy is truly built for the long haul and if your 401k is up to snuff. Call us here at Floyd Financial Group today for your complimentary retirement review at 417-889-7233. It's 417-889-7233 because hope is not a retirement strategy. Well, Jake, we're out of time for this week. I want to thank you for your time, but as I do every week, I want to thank the fine citizens here of Springfield, Missouri, the last bastion of sanity, for joining us. So for Jake Floyd, I'm Jeff Shade, wishing you a great weekend. We'll talk to you again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.